A year ago, private equity giant KKR's outlook for 2024 was titled Glass Half Full. The firm's newly released outlook is titled Glass Still Half Full. Joining us right now is Henry McVey. He's Chief Investment Officer of Balance Sheet at KKR. And I want to talk about a whole lot of stuff, Henry. But can we start, before we get to your outlook, with just talking about what's happening this morning? Because you wake up on a morning like this, you're thinking it's time for the holidays, things are winding down. Not the case if you're watching what's happening in Washington, if you're watching what's happening in the markets.
It's definitely game on. A couple of things I would say. One is, to me, the signal on what's going on in D.C. is that the red sweep is going to have some bumps along the way, right? They're going to have to work with the Democrats to get things done. So I think that's point one. The second was on the inflation. Our view, I mean, we own almost 200 companies around the world. There's still inflation out there, right? Wages are growing, and you're seeing volatility around potential tariffs. And so I think inflation is down from, red alert levels. But if you look at it, we've had 45 months of inflation above the Fed's target. Mm-hmm. And the Fed just told us that they're not going to get to their target until 2027. So that means we have a 6-year period. Most of your viewers have actually never invested in a 6-year period where inflation was well above the Fed's target. I think with the interview with John Williams was really important. Why have we been glass half full? Why have we been deploying capital at a pretty rapid clip? Has been productivity. We talked about this last year. We talked about the mid-year. There's something different going on in the U.S. right now that's not happening in other parts of the world. So if you look at the 1960s, you look at the 1990s, and you look at the last couple of quarters here, we're seeing a surge in productivity, and that's not an AI surge. Companies are doing digitalization, automation. That typically happens when wages go up, so it's not unnatural. But that is really the differentiator. That's why money wants to be in this country, and that's why, if you look at the sell side the past couple of years, they've said that GDP growth was going to be less than 1%. We had lots of calls for the recession, and growth has been fine. And that's what our companies are telling us, right? And so I try to spend a lot of time talking to our companies, talking to policymakers, and then getting out and just seeing what's going on in the economy. And we're starting to see a period, while inflation's come down, it's still up there, but real wages are actually turning positive. And that's why when you look at the GDP for the third quarter, consumption was 3.7%. That's pretty darn strong.
Yeah, so you're continuing to invest. The one thing I will say is the market's knee-jerk reaction to that additional inflation being out there is that it may mean we get fewer cuts from the Fed. And is that a problem? Or do you think the economy will be strong enough to carry that through?
I think the way this doesn't work out, you have big deficits, you've got heightened geopolitics, all the things you were citing. What's offset that has been productivity. So if we end up in a time where I'm back here saying, hey, the productivity story didn't work, then we're going to have a form of modern-day stagflation, because you'll have China's competition on excess goods, but you'll also have big deficits and higher inflation. That's not our base case, but I think that's the narrative you have to watch. We have 2 Fed cuts next year. The market reacted.
Maybe.
Yeah. The Fed. What did the market react to? It said the Fed raised its GDP forecast. It's lowered its unemployment rating, and then it said growth's going to be stronger, and then it cut.
Well, it cut, and it said the additional 2 cuts, if they come at all, are going to come in the later half of the year. So
yeah.
Don't look for it anytime soon.
So I think
that makes it feel like, okay, it's less that you can really count.
But part of what we've outlined in our piece is like the U.S. is going to be the above average area of growth.
And that's where you would be putting it.
Yeah, and if you look at where the cutting's taking place, it's in Europe, Bank of England, ECB, and then China. China has almost close to deflation. And then the one other outlier is the Bank of Japan's actually raising rates. So we've been talking about this whole idea of like an asynchronous recovery, which it used to be the U.S. consumer would lever up, the Fed would cut, they would buy, then banks would delever, we'd have a problem. Now you've got just a lot of very different things going on by country, and you've really got to get out there and see what's going on. One of the big themes, and you guys were talking about this with FedEx, there's a huge movement. One of our big investment ideas is this whole idea of companies going from capital heavy to capital light. What did FedEx just tell you? It told you that they're going to make their capital structure more efficient. We've been doing lots of deals where we own either the equity or the debt. We did something with PayPal, with Discover, very, very active right now in corporate carve-outs across our private equity business. So it's just a different playbook. And so this is a market where you make your own luck. Like, why are we so active in Japan right now? Because Japan has cheap valuations, reasonable funding costs, and there's a corporate reform story going on. Mm-hmm. The other big thing I would focus on is if President Trump does put put tariffs on, which we think they will, the market, money is going to flow to economies that have big consumer economies because they have a wall of protection in that consumption. That would be India. That would be the United States. And that's why I think you've seen strength in the dollar, because money is saying, you know what, in an uncertain world, I want to have a larger part of the economic growth coming from domestic consumption versus exports where I could be exposed to tariffs.